Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the accounting terms too. Hope you will like, share and subscribe our video. Accounting terms 2. The second part. Debit and credit and indirect cost. Debit and credit. To debit an account means to enter the transaction on the debit side of that account. To credit an account means to enter the transactions on the credit side of the account. Debit side means left hand side of an account. Credit side means right hand side of an account. Indirect costs. These costs are the cost which is incurred by the organization, but they cannot be directly associated with the production. Expenses and losses. Expenses is the amount spent in procuring the goods or services for conducting business activities. It is the expenditure in return for some benefits. Example, salary paid to staff, factory or office rents, etc. Whereas loss refers to money or money's worth given up without any benefit in return. It is an expenditure in return for which no benefits are received. Loss of goods by fire, loss on the sale of the assets, etc. Therefore, loss is different from an expense. An expense brings some benefit, loss does not bring any benefit. Rent paid is an expense, but goods destroyed by fire is a loss. Double entry systems and brought down or carried down. Double entry systems record each financial transactions twice, once as a credit and once as a debit. When the sum total of all recorded debits and credits equals 0, the accounting books are considered balanced. This system is also known as double entry accounting. In simple terms, when we buy a machine and pay cash, this is called double entry. Machines comes in and cash goes out of the business. Brought down, abbreviation B/D. Term is written in the ledger to show the opening balances in any account. It suggests that the account has been brought down from the previous period, whereas carried down, abbreviation C/D, is written in the ledger account at the time of closing the account. Sales and direct costs. Sales describes the income of a business earns by selling products or services associated with its main operations. For example, in a furniture business, all the furniture sales are revenue or direct sales, as it is their main operation. Whereas for the metal manufacturing company, if it sells the furniture, it is not named sales, but the term here is known as other revenues. Direct costs. These costs can be directly associated with the production. For example, if a furniture manufacturing company takes 5 days to produce a couch, then the direct cost of the finished product includes the raw material cost as well as the labor charges for 5 days. Trial balance. A trial balance is a statement, a list of all the nominal ledger, general ledger accounts contained in the ledger of a business. A trial balance is a list of credit entries and debit entries that businesses use to internally audit their double entry accounting systems. The rule here is simple: debit all expenses, losses, and assets, credit all incomes, gains, and liabilities. It is prepared at the end of a particular period in time. If your trial balance is incorrect or incomplete, it leads to incorrect annual financial statements. Trial balance is an internal report of the company. Trading account. The trading account is the very first step for preparing profit and loss account statement and balance sheet. Direct sales or net sales and all direct expenses like wages, freight, which are related to the production or procurement of a product, are taken into account while preparing the trading account. The closing stock and opening stock of goods are also taken into account to arrive at the gross profit or loss during a specified period. The gross profit or loss can be determined only from the trading account, which will be transferred to P&L account, that is profit and loss account. Trading account is a part of the final accounts for the entity. A trading account is debited with the cost of goods sold and all the expenses connected with the purchase of goods and credited with sale proceeds of goods. Expenses concerning the sale of goods are not recorded here. Trading account is based on matching the selling price of goods and services with the cost of goods sold and services rendered. Note: the basic formula of a trading report is equal to gross profit slash net sales percentage. Profit and loss statement. Profit and loss account statement or account is a summary of all the company's transactions during a period of time and is usually a 12-month period. that contains incomes, expenses, gains, and losses. All the direct and indirect expenses, marketing and advertising expenses, selling, general and administrative expenses, depreciations, provisions, interest expenses, taxes are recorded in this account statement. It is prepared upon the accrual accounting method and is one of the four financial statements determining the position of the business organization. As a rule, all expenses and losses are shown on the debit side and all incomes and gains are shown on the credit side of the profit and loss account. Then the totals of debit side and credit side are compared for ascertaining profit or loss of the business during the accounting period. The net profit or loss can be determined only from the profit and loss statement, which will then be transferred to the balance sheet. The basic formula of a P&L report is as follows: net profit slash sales percentage. Also, net profit slash loss is equal to incomes less expenses. Hope you like our video. For more videos, please do not forget to like, share and subscribe our channel Accounts and Finance with FAR SK. Thank you. Have a great day.